What is a bear market in Forex trading? Welcome to our video on understanding bear markets in Forex trading. In this video, we'll explore what a bear market is, the dynamics involved, its phases, causes, and strategies to navigate through these challenging times. A bear market in Forex trading occurs when currency values drop significantly, often by 20% or more from their recent highs. This typically happens when a large number of investors start selling their assets, leading to a market downturn. Unlike a bull market that trends upwards, a bear market moves downward, instilling fear among investors. Bear markets can last from a few weeks to several years and often start due to economic recessions, market bubbles, or significant events like the COVID-19 pandemic. Bear markets signify a substantial drop in currency values and are characterized by negative investor sentiment and widespread liquidation. They tend to recur approximately every 3 years, making preparedness crucial for traders. Bear markets can be triggered by economic recessions, geopolitical events, or major disruptors. Understanding these downturns and prolonged price declines helps mitigate risks and enhance trading strategies. In Forex trading, a bear market means asset values fall by 20% or more for a period. It's important to understand these conditions as markets shift due to economic slowdowns or major crises. Analyzing market downturns helps traders navigate tough moments. Before a bear market, a market correction occurs with a 10% drop in asset values. In Forex cycles, sellers dominate while buyers withdraw, making it essential to have the right strategy for bearish trading conditions. In a bear market, traders should evaluate situations, compare options, and make careful decisions. Day trading might offer quick gains, while others might make significant purchases hoping for better times ahead. During fast market movements, using multi-level stops and technical analysis tools is wise. Understanding why the market falls is also crucial. Practicing in a demo account during bearish conditions builds confidence for real trading. To understand Forex market cycles, one must see how bear markets impact everything. By mixing bullish and bearish investments wisely, traders can potentially increase earnings. Bear markets generally fall into different phases: bear normal, bear volatile, bull normal, bull volatile, sideways quiet, and sideways volatile. Each type has a typical duration and condition, influencing how traders should approach their strategies. Succeeding in bearish trading conditions requires selecting the right trading system for current market trends. Thus, continuous analysis of Forex market cycles is vital for traders. A bear market progresses through various phases. These include high prices and investor sentiment, a sharp decline and panic, speculation and temporary rallies, and continued decline with slow recovery. In the first phase, prices are at their highest and investor confidence peaks. However, smart investors start cashing out, setting the stage for a market fall. The second phase sees a rapid drop in prices, known as the market collapse. Panic selling ensues as investors rush to minimize losses, worsening the downturn. The third phase involves short-term rallies and speculative trading. Some investors see opportunities at lower prices, but these gains are often temporary. In the final phase, prices continue to decline, but at a slower pace. Eventually, lower prices and positive news attract investors, signaling the start of recovery and potential transition to a bull market. Bear markets in Forex trading can start due to economic recessions, currency devaluation, geopolitical crises, and government or central bank interventions. Understanding these triggers helps traders cope with market instability. An economic slowdown, marked by lower employment, GDP, and stock prices, often leads to a bear market. This reduces investor confidence and market stability, making traders more risk-averse. Currency devaluation strategies by governments to boost exports can negatively impact market sentiment. This often leads to traders avoiding the weakened currency, pushing the market downwards. Geopolitical crises like wars, political instability, or natural disasters can cause significant shifts in Forex markets. These events increase risk perception, causing market instability and downward trends. Government and central bank interventions, such as changes in tax rates or interest rates, can shake the Forex market. While their actions aim to stabilize economies, they often cause market fluctuations. Market volatility is a major issue for Forex traders. It represents significant price changes due to economic news and investor sentiment. Measuring volatility helps understand the level of trading uncertainty. Typically, around 68% of prices stay close to the average. The volatility index, VX, usually remains in the low 20s but can spike to the 40s or 50s during rough markets. For instance, in March 2020, the VX hit 82.69 due to the COVID-19 pandemic. Investors generally expect an annual return variability of 15%. However, significant market drops of around 30% can occur once every 5 years, showing the connection between bear markets and high volatility. The US stock market usually yields about 10% annually. Missing top trading days drastically reduces this number. Interestingly, the top 10 trading days often occur during bear markets. Forex traders must manage trading risks during volatile bear markets. Being prepared for tough times and spotting opportunities is crucial. Using smart strategies helps reduce risk and capitalize on potential gains. In bear markets, understanding investor sentiment is crucial. Traders quickly become cautious, selling assets to avoid significant losses, which further reduces overall investment value. Negative sentiment during bear markets leads to panic selling. Investors, fearing further losses, sell rapidly, exacerbating the downturn. Historical data indicates losses of up to 31.7% during bear markets, reinforcing the prevailing negative sentiment. Investors shift their risk appetite during bear markets. Riskier investments become less popular, while safer options like gold or government bonds gain preference. This shift in investment preferences impacts market dynamics, with investors focusing on less risky assets to protect their capital. Effective risk management in Forex trading involves strategies like short selling, using put options and inverse ETFs, and employing hedging techniques. Short selling allows traders to profit from falling prices. They borrow assets, sell them, and repurchase them at lower prices. Quick decision-making is essential to avoid losses if prices rise unexpectedly. Put options and inverse ETFs help mitigate losses. Put options enable traders to sell at a predetermined price, ensuring returns during price drops. Inverse ETFs perform inversely to the markets they track, benefiting traders predicting a decline. Hedging strategies in Forex trading involve using additional investments to balance risk. By carefully selecting investments and setting stop-loss points, traders can protect against significant losses. Historical bear markets in Forex trading, such as those during the 2007 to 2009 financial crisis, the COVID-19 pandemic, and the dot-com bubble, provide valuable insights. The 2007 to 2009 financial crisis caused significant turmoil in global financial systems, affecting Forex markets. Currency values dropped, highlighting the impact of economic uncertainty on markets. The COVID-19 pandemic rapidly triggered a bear market. Lockdowns and reduced consumer spending led to a swift decline in many currencies, with the S&P 500 falling 34% in March 2020. The dot-com bubble burst in the early 2000s led to a prolonged bear market. The tech crash severely affected currency values, underscoring the importance of understanding economic sectors that withstand downturns. Trend analysis is vital in Forex trading, especially during bear markets. It helps traders identify market directions, crucial for making informed decisions amidst significant changes. Analyzing current trends allows traders to predict future movements. Tools like moving averages and trend lines help spot trends and make strategic decisions. Identifying a downturn early through trend analysis helps traders minimize risks and seize market opportunities. By understanding these trends, traders can better navigate bear markets and enhance their trading success.